Welcome to the Teaching You to Fish podcast, financial literacy for the rest of us. My name is Carl Fish, and I'm the host of this podcast. This is episode 13, Investing Part 3, Compound Interest and the Secret Life of Fees. In our previous two episodes, we learned the vocabulary of investing and what you need to know to make good decisions about asset location, allocation, and tax status. In this episode, we're going to look at the incredible wealth-building capabilities of compound interest, but also how high fees can dramatically decrease your overall returns. First, a reminder. Compound interest is when the interest you receive goes on to earn interest itself, building your wealth like a giant snowball. It's important to understand that while the word interest is part of compound interest, this is not just talking about the kind of interest you can earn on a savings account. The interest in this case is any kind of growth in the value of your investments, which certainly includes interest, but is usually talking about the dividends and capital appreciation your equity and bond investments earn. The yellow bars on this chart are the sum of the investments, and the purple bars are the sum of the interest those investments have earned. As you can see, over time the interest on the interest usually ends up far exceeding the amount you've invested. When you are first starting out, the amount you save and invest is going to be the largest component of the value of your investments. As discussed in previous episodes, the amount you save and invest is definitely important. But there are four factors that are key to how quickly your interest compounds that are independent of how much you are saving and investing. The four factors are your rate of return, the fees you are charged for investing, the timing and the amount of taxes that you'll owe, and the amount of time you have to let the investment compound. In episode 10, we talked about taxes in general, and in our last episode, we discussed the different tax treatments of taxable accounts, traditional pre-tax accounts, and Roth accounts. So I'm going to focus on the other three factors. This chart shows how important it is to get compounding started earlier rather than later. Note how much less you have to invest each year, and cumulatively, in order to get to $1 million if you are investing for 40 or 50 years compared to only 15 or 20. The most famous investor most people have heard of is an excellent example of this. Here's a chart showing Warren Buffett's net worth over time. Close to 99% of his net worth has come since he turned 65. That shows the power of compound interest and how important time, and getting started as early as possible, is in building wealth. It also helps that Mr. Buffett has achieved very high rates of return over his long investing career. It's important to get started as early as possible, but it's also important to achieve a good rate of return, because the higher your rate of return, the faster your money compounds. A quick way to think about this is known as the Rule of 72. The Rule of 72 gives you a quick estimate of how long it takes to double your money based on your rate of return. Pick a rate of return, say 7%. Divide 72 by 7 and you get a little bit over 10. That means with a 7% rate of return, your money will double in about 10 years with no additional investments. If your rate of return is 5%, it will take a little over 14 years to double. If your rate of return is 10%, it will only take about 7 years. The differences between those are fairly obvious, but it's when you go out further that you can really see the difference. Because if you get a 7% rate of return and your money doubles in about 10 years, it also doubles again in the next 10 years, meaning it's now 4 times as much after 20 years, and then doubles again in the next 10 years. So it's now 8 times as much after 30. After 40 years, it'll be 16 times as much. After 50, it will be 32 times as much. The secret of compound interest is to get a high rate of return, but also to hold on to those investments long enough to hopefully get to the 16x and the 32x. As those doublings have a much greater magnitude. As discussed in our last episode, your rate of return is largely determined by your asset allocation, with stocks historically earning more than bonds, and bonds historically earning more than cash. I stated that everyone should be investing only in index funds and promised to go into more detail. So here's the detail. A reminder that index funds are mutual funds, or ETFs, that invest in a low-cost, diversified mix of all of the stocks or bonds in a particular market index, such as the total U.S. stock market, or the total international stock market, or the total U.S. bond market. Index funds are passive investments, and many people, including some investment advisors, think that actively picking stocks and bonds should outperform the indexes. It turns out, however, that that isn't the case. There are two main reasons for this. First, if one stock or mutual fund or investment manager beats the market index, that means by definition there has to be someone on the other side who performed worse than the index, because the index is the sum total of all investor performances. The second reason is cost. It is much more expensive to research stocks and to actively buy and sell them than it is to just buy and hold an index. Plus, those active managers have staff they have to pay, and they need to make money, typically a lot of money, themselves. Those costs are passed along to you in a variety of ways, with the most common being administrative fees and expense ratios. As discussed in episode 11, investment managers charge administrative fees for managing your money. These sometimes include fixed dollar amount fees for just having the account, typically charged quarterly or yearly. And then they charge a percentage fee of assets under management, which is a seemingly small percentage of your total balance. While this percentage has been coming down some over the years, it is still often 1% or more of your balance. For many people, 1% doesn't sound like very much, but it is. Imagine that your investment returns 5% in a given year. Well, in that case, a 1% management fee is taking 20% of your returns. Now imagine it's a year when the market is down, so you lose 5%. With a 1% management fee, you're now losing 6%, or 20% more than you were already losing. And it gets worse, because just like the incredible power of compound interest when it is working for you, the drag from management fees compounds each year and works against you. That 1% in management fees can often result in losing over a third of your gains, depending on your rate of return and how long you stay invested. And then there are expense ratios, the fees charged to invest in specific funds. There's nothing inherently wrong with expense ratios. Running a fund costs money, and those expenses need to be paid for somehow. But actively managed funds, or sometimes even passively managed funds that you're investing in through an investment advisor, have much higher expense ratios, which then end up subtracting even more from your returns and compounding in a negative way year after year. This subpar performance is often hidden because the market generally goes up, so you will still typically make money even with high fee investments. So it looks like you're doing well, but that's because you are not comparing your performance to a benchmark, the index. Some folks who understand this still seem to think that they, or their investment manager, can still overcome these costs because of their superior stock picking ability. But the evidence shows otherwise. Yes, in any given year, some active stock pickers will beat the market. But the problem is that the managers who beat the market one year aren't necessarily the managers who beat the market the following year. What the evidence shows is that over 10 years, only about 17% of professional money managers beat the market. Over 20 years, it drops to 14%. After 30 years, it's only about 1%, and nobody knows who that 1% is going to be in advance. This is why we invest in index funds, because they will beat 99% of the professional money managers out there over longer periods of time and, just as importantly, help us achieve our long-term investing goals. And even for those 1% that do outperform, it may not be due to skill, but simply luck. Being a former math teacher, I naturally tend to rely on some of my teaching experience to try to convey this idea. Pretend I've asked you to flip a fair coin 10 times. How confident are you that you will flip 10 heads in a row? If you're like most people, probably not very confident. You know it's possible, but not very likely. But what happens if I asked 1,024 people to flip a coin 10 times in a row? In that case, you would expect at least one of those 1,024 people to get 10 heads in a row. Here's the million-dollar, perhaps literally, question. Do you think that person is especially skilled at flipping coins? I hope, most people would say, no, they aren't skilled at flipping coins. It's just chance. It was random. So now let's think about asking 1,000,000 people to flip a coin 10 times in a row. What would we expect? We would expect about 976 of them to flip 10 heads in a row. How about all 330 million people in the United States? We'd expect over 322,000 of them to flip 10 heads in a row. Population of Earth, 7.75 billion. We would expect over 7.5 million people to flip 10 heads in a row. That's a lot of people who are really good at flipping coins. Yet, when 1 out of 1,024 investors beats the market, they most likely think they are especially skilled at investing, and they truly might be. But we have no way to tell because it could just be luck, totally random. We would expect over 322,000 Americans to beat the coin flipping market from luck alone, and it would be indistinguishable from skill. And if you expand out winning to flipping 10 heads in a row or 10 tails in a row, that would double the number of people beating the market. So, when your cousin Ralph boasts about their investment prowess, or that their financial advisor can beat the market, how do you really know it is due to skill and not luck? This is a critical question to know if you want to know if the money you invest with them now is going to outperform in the future. One additional thing I've always wondered about folks who think their financial advisor can consistently beat the market. If they can, why are they working with you? Either they should be working with very high net worth individuals, because they will make much more from them than from you, or they should already be fabulously wealthy themselves because they know the secret to beating the market. Spending time helping you beat the market is really not the best use of time or return on investment for them. So we're now going to do an activity where we compare what your long-term returns could be with different asset allocations and with different levels of fees. Open this Google spreadsheet by typing in the link or clicking on the link in the slides. It will ask you to make a copy so that you have an editable version. Click Make a Copy. This spreadsheet allows you to enter in your asset allocation split between stocks and bonds, your expected real rate of return on each, and the administrative fees and expense ratios for your particular vendor and investments. In cell H2, enter the percent you want to allocate to stocks. On the first tab of the spreadsheet, it defaults to 100%. Notice there are multiple tabs across the bottom, each already filled in with different asset allocations as examples you can look at, but you can also modify any of them. In cell H3, enter the assumed real rate of return for stocks. A reminder that the real rate of return is the return after inflation. Historically, that has been right around 6.8%. Cell J2 will automatically calculate the percent in bonds by subtracting what you entered in H2 from 100%. Do not manually enter anything in cell J2. Simply adjust H2 to the percent you want, and J2 will adjust. In cell J3, enter the assumed real rate of return for bonds. Historically, that has been right around 1.6%, so that's the default. Then down below in rows 6 and beyond, there are spaces for 3 vendors. The default is Vanguard in columns A through D. Then, as an example of a particularly bad 403B, in columns F through J, there is Equitable's Equivest 403B product. And then, in columns L through P, there's an opportunity to enter in the information for your investment vendor. Let's look at Vanguard briefly to get an idea of what you want to enter for your vendor. Cell B7 is where you enter the expense ratio for the stock fund you're going to invest in for this vendor. For Vanguard, that's 0.04%. Cell D7 is for the expense ratio for the bond fund for this vendor. For Vanguard, this also happens to be 0.04%. Cell B8 is for any annual fixed dollar amount administrative fee. For Vanguard's individual accounts like IRAs and taxable brokerage accounts, there is no charge, so this is $0. Cell D8 is for any administrative fee for assets under management. Again, for Vanguard's individual accounts like IRAs and taxable brokerage accounts, there is no charge, so this is 0%. Cell D9 then calculates the blended fee percent based on your asset allocation, the expense ratios for the stock and bond funds, and the administrative percentage fee. Column B, starting in row 11, lists the amount you'll be investing each month for the first year. It defaults to $500. Each subsequent year copies that monthly amount. You can change any monthly amount and it will automatically change the amounts below that, although you can also change the amount individually in any given year. Column C shows your balance at the end of each year. For example, cell C16 by default shows $44,245, which would be your ending balance at the end of year 6. If you scroll down, you can see the impressive work that compound interest is doing. Column F through J then gives an example for one of Equitable's 403B choices, including their much higher fees. It then adds column I that shows the dollar difference between your balance in Vanguard and your balance in Equitable given the exact same investment amounts. It then adds column J, which calculates the percentage difference between Vanguard and Equitable. As you scroll down, you can see the incredible and incredibly depressing impact that fees can have on your overall returns. After 36 years, you've given up half your returns to fees compared to Vanguard. It's also important to realize that these are the best expense ratios that Equitable offers in this product. Many of their other funds are more expensive. For example, their target date fund has an expense ratio of 1.1% compared to Vanguard's 0.08%. Then columns L through P allows you to enter in the information for your vendor and investments. Be sure to enter in all four values: stock expense ratio, bond expense ratio, any fixed dollar administrative fee, and any percentage administrative fee. You may have trouble finding out the fees, as some vendors make it very difficult. And there are definitely fees, so keep looking until you find them. Be persistent. And if you really have trouble, reach out to me and I'll see if I can help you find them. Once you've entered in the fees for your vendor, scroll down and see any impact those fees have on your overall portfolio value. If you want to change the monthly investment amount, change that back in cell B11 and will automatically update the monthly investment amounts for all three vendors so that you can compare. It's also important to realize that by using a real rate of return, the return after inflation, the really large amounts that your portfolio is worth years down the road are in today's dollars, meaning it has today's purchasing power. If you are taking notes throughout this series, take a screenshot of your completed spreadsheet and add it to your notes for reference. I'd also suggest adding a link to your copy of the spreadsheet so that you can return to it if you want to. Then perhaps write a paragraph or two, or more, reflecting on this exercise. If you're comfortable sharing your reflection, there are several ways to do that. If you're watching or listening to this on Spotify or YouTube, then you can leave your thoughts and/or your feedback or questions in the comments. You can also always reach out to me directly on social media or via email. I'm Carl Fish on Blue Sky, Twitter, Facebook, and YouTube, or you can email me directly at carlfish@gmail.com. This episode hopefully powerfully illustrates the wealth building capabilities of compound interest, but also the wealth destroying capabilities of high fees. If you are currently invested in a high fee vendor, switch if you can. If you can't, perhaps because your employer only offers high fee vendors for your employer-based plan, make sure you are invested in the lowest cost index fund choices they have available. I can't emphasize enough that you need to find out the fees associated with your investments, and if they are high, switch if you can. And if you think you don't have fees, you're wrong. Sorry, but it's true. Keep asking. After any employer match, make sure you're maxing out your IRA before investing any additional money in a high fee employer-based plan. Be sure to get started investing as soon as you can so that compound interest can work its magic. Try to invest as much as you can and try to increase the amount you're investing each year. One technique that works for many people is to invest half of their raises each year, and this linked blog post gives an example of that. In our next episode, we'll take a look at investing for college through a 529 college savings plan.